Good afternoon, everyone. It's great to be with you again. Brad Macbeth here from The Simple Plan with The Simple Plan Live. And we're going to talk about investing basics today. We're going to look at some very fundamental concepts around investing that we hope will encourage you to begin investing. This is the time of year when people are thinking a lot about their money, both because it tends to come in after Christmas and the New Year's. Also, we have deadline at the end of February for making contributions to an RSP. So for the prior year, you can still make contributions to an RSP right now for your 2021 tax year if you wanted to. So a lot of people are thinking about their investing and personal finances right now, and we just wanted to dig right down into some real fundamentals. But before I go into that, I really I would be remiss if I didn't make some mention of what's going on in our country right now, particularly from a financial point of view. There's been two significant stories this week. One is that inflation is now running at 5.1%. And it's been quite a while since we've seen inflation running at that level. Now, I commented about inflation a little while back in an episode, but it's a serious business and it's here and we need to be taking it into account. So from an investing point of view, for example, if you've just got your money tucked into a savings account, well, you're probably getting somewhere from 0.05% up to maybe 0.5% interest on your money. At 5.1%, that means your money is going down by about between 4.5% and 5% per year. You're losing purchasing value because of inflation. So it really is important to have your money working for you at the same time as being cautious, not to be risking it in a way that you can't afford to. So for example, if you've got money tucked away that you need, in 3 months to buy something or do something, then yes, you don't want to be investing that. But for anything that's medium to longer term, you want to be seeing what you can do to get a better rate of return right now. Otherwise, your money is just dying on the vine. Now, the other major event that's going on, aside from all the politics, is the declaration of the Emergencies Act here in Canada, which is, I'd love to say it's unprecedented in my lifetime. Sadly, that's not quite true. Its predecessor, the War Measures Act, was invoked in 1970. And whatever you think about what took place then, times are very different now. This act is also somewhat different, but still very draconian. And we're seeing people, I want to address the financial end of it, which is people are having their bank accounts seized by the government. The government has also interfered in the GoFundMe and another lesser known fundraising vehicle. Now, I'm not a huge fan of those fundraising vehicles for many purposes, but nonetheless, they're legal and people have legally put their money into something that was completely legal and then subsequently has been sort of declared illegal, but without any form of due process whatsoever, without even an act of parliament being passed. So now people are having their money seized by the banks, where the banks are being instructed to so do, and is actually much left to the discretion of the banks. So that is certainly unprecedented in my lifetime. I would argue it may well be unprecedented in Canadian history, though I don't know that for sure. And so whatever opinion you hold about what's going on with protests and trying to remove the protests and disruptions. And I understand many points of view on both sides of those issues. The fact that the government is all of a sudden out of nowhere now seizing people's money without any form of due process whatsoever really should be something that's of great concern to people. It really is unprecedented, and it's unprecedented in other countries that we consider kind of Western democracies. Of course, yes, people who have been convicted as criminals, have their assets seized, frozen, whatever, be that as it may, but that's after extensive due process. This has had no such thing. So the only comment I can really make about that is I think, yes, you should be alarmed that this kind of thing can take place, because generally speaking, once governments take powers, they tend to use them in the future. So we'll see how this all unfolds. It's all happening now, so it's impossible to say. But people are being arrested, accounts are being seized, and it's a disturbing turn of events. And you would do well to pay close attention to it and weigh in on it, whatever your point of view is, with your political leaders. So let's shift over to talking about what we came to talk about today. I want to first thank our sponsor for this week again, the Simple Plan community. Come join us there. It's free, and we're going to be answering questions. We always are. We've got folks in there that are on the same journey that we're all trying to take, which is to make the most of our money for our family and for our future, and finding the best ways to take care of that. So come join with us there, and we're really all about the how-tos and the why-tos, and if you're having trouble or you're stuck answering your questions, we'll answer your questions. People in the community will answer questions. So come join us there, the Simple Plan community, facebook.com/groups/Simple Plan community. And so today, I want to talk about investing from a fairly basic perspective. And I think a lot of people are, feel like they should get started investing, but they don't quite know how to. And I see a lot of people asking questions in Facebook groups that are really not moderated groups, in the sense that there's no, it's impossible to tell in these large groups who really knows what they're talking about and who maybe thinks they do, but is giving out erroneous information. And some of that information can really cost you. So you want to be taking credible advice. The other thing I want to mention is that there is no one size fits all. There are many, many, many ways to manage your finances, and a wide range of perspectives and opinions on how to do that. We have a particular point of view, which is primarily to optimize and maximize rates of return on our money, following a well thought out and well actioned plan, but minimizing, or maybe not minimizing, but mitigating risk along the way. So we're not in favor of taking big, huge risks with investments, but we think that there are some pretty good systematic ways that you can build a plan, and if you're diligent about following it and funding it, that it can lead to some real prosperity in your life. Here in Canada, we live in a very prosperous country, and there's a lot of opportunity to do well for yourself without having to take the risks to shoot the lights out or do anything really speculative. So I want to just run through a few calculators that will show you illustrate some different principles for you. So the first principle is, when you're investing, when you're saving and investing, you really have to have a clear goal in mind. And that goal could be short term. Could be like, well, I want to save up some money to go to an event 3 months from now. Well, that obviously doesn't require too much thought or planning, other than you need to systematically set a little bit of money aside for that. There's not going to be any investing involved in that. You can put the money in that bank account if you want, or you can just put it in a jar at home. But as we move toward bigger things, things like perhaps significant travel that might cost you several $1,000s, or taking care of or buying a vehicle, which could cost you many thousands of dollars, or all the way up to purchasing a home, which we talked about extensively last week, if you're saving up a down payment for that. So each of these has a couple of, really 3 factors. One is, how much do I need? When do I need to have it? And where am I going to accumulate it while I'm saving for it? And the reason for that is because if you're really looking at nearer time frames, 1 to 2 years, you need to be pretty conservative if you need to be certain that the money's going to be there. So if you're planning on buying a home in 18 months and you need to save up $50,000, for example, well, and obviously that would be an aggressive goal, depending on your income. But let's say that's what you're setting out to do. Well, you'd like to get a little bit of return while you're accumulating that money. But you want to be sure more than anything that the money's going to be there when you go to buy that house in 18 months. So if you're investing in, kind of longer term investments like mutual funds that have stocks in them, then you probably want to be very cautious about that. So I'm not going to get into what investment types to look at today. I just want to lay out some basic principles of what you should be thinking about when you're going to begin investing. So I thought a fun target we could look at, because it seems a round number that a lot of people think about, is what's it going to take if you wanted to save $1 million? Now, if you are 67 and have only 2 pennies to your name, that's going to be a very challenging goal. But you'd be very surprised if you're 25 or 30, that's really not a particularly aggressive goal. So let's take a look at that. So we've got our mortgage calculator here, and it shows us, let me just slide it over here. All right. So it shows us what we would need to do. So it's got its default values here, which is starting with someone who's 25. If they have initial savings of $10,000 and they're saving $5,000 annually, here's a rate of return and the inflation rate. This is calculating that you would become, using these numbers, you would become a millionaire at age 67. Now, of course, let's pick a different age. So let's say we're actually 33. We're either going to be waiting till we're age 75, or we need to adjust some of these things. Now, I just said inflation's running at 5.1%. I don't think it's going to remain at that, but I think it is going to be higher than what it's been. I would have been comfortable a year ago with saying 2%. Now I think we probably really want to go, I'm going to say we should go to let's just go with 3. By the way, the very long-term rate of inflation has run closer to 4%, just so you know. And as we looked at previously, there's been some very high periods of inflation. So at 3%, I also think if we're looking at a long-term target, we can get a better rate of return. So let's say that we're going to get an 8.5% rate of return. Well, that brings us down into reaching our target there at age 66. That seems a little nicer. So, but let's say that we would like to be there by the time we're 55. Well, if we've only got initial savings right now of $10,000, we can't really adjust that. So the one thing we can adjust is how much we're saving every year to reach this target. So let's see what would happen if we increased it by 50%. How much faster would we get there? We go from age 66 to age 62. Okay, that moved the needle a few years. And if we did $10,000 in annual savings, now we're down to 59. So we could retire at age 60 with our $1 million. And so you get the idea, right? That in this case, it's going to take you 26 years to become a millionaire, and you would have $1 million and change by the end of the year in which you turn 59. Now, notice this little snippet here. This amount is equivalent to $481,000 in today's funds if inflation continues to run at 3%. So let's just run a little experiment here. What if it really were continuing to run at 5.1%? It's not going to be pretty. All right, so here's what 5.1% inflation means. Over 26 years, you see, 26 years, it's going to reduce our purchasing power from $1 million to $280,000. That means that your dollar in 26 years at 5.1% inflation is only going to be worth 28 cents in today's purchasing power. That's about a quarter. So 26 years, 5.1% inflation is decimating your money down to 25% of what it's worth today. Anyway, that's just an aside, but you can see why we need to be concerned about long-term inflation. Okay, so we hear a number of principles when we're getting started with investing. And so one of them is called pay yourself first. And so what does that mean? It means take the money off the top. Most people trying to save and invest tend to think in terms of leftovers. Like, well, you know, I've already got this, that, maybe I can scrape together, you know, $100 this week or this month to invest. And if that's where you're at, then that's where you're at, and just live with it and get started. And we're going to see why you want to get started. But if we get into the mindset instead where investing for our future is just as important as paying our bills, as paying our mortgage, as running our car, and probably more important, though, you know, we won't necessarily feel that way, than entertaining ourselves or going on holidays. So I'm not saying you shouldn't entertain yourself. I'm not saying you shouldn't go on holiday, but you should not think that I'll do all those things and then I'm going to put aside a little bit of money. So the first thing we did was we had a goal. And in this case, we were talking about $10,000 in annual savings. That would be about $850, we'll call it $850 a month. Okay. Now, we're big advocates of doing it from a percentage point of view. And here are how the numbers work. It just happens to be how they work. So don't shoot the messenger. But if you want to be very confident that you're going to reach a good investing goal, a good savings and accumulation goal over a long period of time for retirement, so enough money for you to live in retirement, you will get there without having to worry too much about ups and downs or whether you're always perfectly invested in the right thing by saving 15% of your income. So let's say you have a $75,000 salary. If you say, well, I'm going to invest 15% of that, whatever happens, and then the rest of my budget is just going to fit in around that. That's what paying yourself first is about. Okay, so that means monthly you'd be putting away $938. And let's compare that to just doing 5% of that. You know, which is kind of more the leftovers approach. And honestly, most people aren't even investing nearly that amount. The average Canadian is putting aside, it's actually changed since COVID, thank goodness, because it was down to zero. So probably it may well be that people, the average is putting away 5% right now. So let's compare that. $75,000. And let's imagine we're age 35 and we're aiming to retire at age 65. So that's going to give us 30 years of accumulation. Okay, so just to review, we earn $75,000. We're going to invest 15% as compared to a lowly 5% for 30 years. Now, what is the result? If I only pay myself, if I only put that 5% in, over 30 years, I only accumulate $315,000. But if I paid myself 15%, over that 30 years, I'm going to accumulate closer to $1 million. It's a difference of $630,000. Now, time is very much your ally, and we're going to see that. But if you miss time, it's very hard to recover because the other factors are harder to control, like rate of return, and you take more risk as you seek to increase your rate of return. But again, let's go to that 8.5% that I was talking about and see where we get to. All right. So the difference at 8.5% between 15% and 5% is $1 million. In fact, at 8.5%, let's see, we can take our pay yourself slider here, and we'll just slide it down till we get to the mill. Okay, there we go. Okay, there you go. If we do get 8.5%, we could actually get away with only saving 10%, and we would hit that million. Now, my advice would be don't play to the minimum, because if you miss the target, if instead of getting 8.5, you get 7.5, you're going to fall a couple $100,000 shorter here. And when you're 65, you have less room to maneuver. It's like, okay, what am I going to do? I'm going to keep working. Sure, you can do that. Or I'm going to live on less. Those are kind of your two choices at that age. So you get my drift, but these are really the tools that will help you figure out how much you should be putting aside to reach a target and what your rate of return might be. Now, again, we're talking fundamentals here. These are simplifications. There are other big questions that involve things like taxation, which includes whether you're going to invest in an RSP or a TFSA, all that stuff. Now, I'm just going to put in the comments there so that you can see this yourself, this calculator. You go try it out for yourself if you want to. There we go. Now, why is that all red again? Let's make that white. I thought I fixed that. Oh no, I think I went through this last week, didn't I? Put that on the list of things to do. Okay. Excuse me. Anyway, it's there in the comments. Okay, so we've now got two principles laid down. Have a target and then pay yourself first. Now, a couple of things to keep in mind on the paying yourself first is, look, the best time to start is when you were 18 or 15 or 12. But the second best time to start is today. So let's look at what it costs to delay. Okay, so we'll go back. What numbers were we using there? We're investing $7,500 at 8.5%. Okay, so we're investing, we'll start with zero. We're investing $7,500 for 30 years. We'll slide that over to 30. And we're going at 8.5%. Now let's just slider. We'll use the slider. Okay, so there we go. There's our $1 million again, 7,500, 30 years, 8.5%, $1 million. Now, I'm telling you, if you didn't start when you were 12 or 15 or 18 or 2 years ago or even last month, start today. And why is that? Because I got this to do and I want to do that. Believe me, the mantra of everyone who is over 45, and certainly those who are well beyond that, is I wish I'd started sooner. So let's just look at what happens if we delay, how much we're going to fall short. So let's see if we wait. Let's wait 5 years. Okay, so if we delay 5 years from starting, so $7,500 a month, or $7,500 a year, 30 years of growth, but we're not starting until 5 years from now. So we missed the first 5 years of growth. We only get 25 years. So we slide all the way down to 640,000. But what if we wait longer? I'm only 23, I don't need to do that. I'll start when blah, 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 blah. Okay, let's say we're going to wait 10 years. All right, So now instead of accumulating that $1 million, we're only getting to 393,000. We've lost 617,000 of what we were going to have. And this is, when you're thinking about living in retirement, there's one of two things going to happen here. You're either going to delay a lot longer in order to get there, or so instead of retiring at 65, you're going to retire at 75. And believe me, it gets harder to work the older you get. Or you're going to live on less. So you would be living on less than 40% of what you could have lived on. So what are you not going to do? Well, you're not going to do a lot. You're not going to travel. You're not going to give. You're not going to be able to help out your family financially. You're not going to be able to leave a legacy. Those are all the things you're going to be giving up. Now, if you're choosing to do that, that's perfectly fine. If you have a plan and that's your plan and it's like, this is what I want to do, fantastic. There's nothing wrong with that. But if it's just, well, I never bothered, I never got started, never thought about it, I just ended up here. That's not how you want to live. That's not how you want to be. So there's another big lesson. Don't wait, start now. And if you have to start smaller now. So we have someone asking, do these numbers include compounding? And the answer to that question is, yes, they do. Those numbers are factoring in compounding. So 8.5%, 30 years of growth at $7,500 a year. So let's do the math there. $7,500 a year for 30 years means we've put in $225,000. And it is the compounding growth that has raised that $225,000 from up to just a little over $1 million in those 30 years. And that's compounding at 8.5% per year. Okay, so now another question that we get all the time is, what should I do? Now, the approach we take with investing tends to be minimize risk, take as much risk as we can out of the equation, but being sure that we're getting a good quality return still. And so, some people argue, oh, well, I could find a mutual fund that will get me 15%. And yes, that's true. There are some of those, but they're very volatile. They go up and down quite a bit, including years of significant downturns. And most people aren't comfortable with that. And those, because they're high risk, there's potential to lose significant amounts of money. But one of the things we should really not do is try to time the market. And the other way of saying that is to stay invested. And so what's happened is that people have are reactive. We're emotional beings, so we get reactive to situations. So when I've been fielding calls this week, with everything that's going on, right? All the chaos, what should I do? And it's like, well, if you take all your money out of your investments and stuff it into your mattress, your 5.1% inflation is going to chew through it. It's if you really are concerned about governments seizing money, and I'm not saying I certainly think at a kind of a principle level we should be concerned about that. I don't think practically we have to be concerned about that yet at an individual level, but the answer to that is I'm not sure what you do if you actually believe that that's a significant future problem. But otherwise, trying to be reactive to what's going on is what's called trying to time the market. People that do that, some of the most obvious ones are people that are day trading, for example. They're trying to buy and sell investments based on daily, hourly, even values to a minute or a second. And some are successful at that, most aren't. It's extremely challenging and extremely high risk for all sorts of reasons, mostly because we can't really explain and know why the market moves as it does from day to day. Just as an example, if we look at what happened at the beginning of the pandemic, back in 2 years ago now, March 2020, what you would have thought happened, which is, oh my gosh, there's a global pandemic. What's going to happen? And a lot of the market crashed. Really, it did. It went down quite substantially over about 6 weeks. It was an extremely large crash. But then it came all the way back, and then some. And you kind of go, well, okay, it's not like things were any better after 6 weeks. Things looked worse. And in fact, we're 2 years down the road now. And yet what you would have thought, I think many people would have thought, well, global pandemic, lots of industry disruptions, whole industries in deep trouble, like travel, airlines, mass entertainment, et cetera, restaurants, nightclubs, all that kind of stuff. Nonetheless, it's hard to find employees. We're floating at what's fairly close to full employment for Canada. It's the economy's in a lot of ways booming, and the stock market's roaring, or at least it was until kind of a couple months ago. And I certainly wouldn't have thought that, and I don't think most people did, but that's what's happened. So if you're trying to time what's going on through all that, you're really trying to figure out human behavior on a mass scale, which we really aren't very good at. So what does stay invested mean? Well, if you try to time the market and you even miss out on, short periods of time, you can really mess things up. So again, let's go with our $225,000. That is our total investment, and we'll just make it a 20-year period. So if you had missed if you didn't miss anything, now this is just the S&P, which has actually not done that great over this period of time. So if you'd been in the S&P 500, you'd have done significantly better. But if you just stayed invested in the S&P, the TSX, which is the Toronto Stock Exchange, the Canadian market, then you would have $743,000 accumulated from your $225,000 that you had starting in 1999. Now, if you timed the market and missed, let's start here. Let's say if we missed the best 1 month, just the best 1 month, we drop by more than 10%, down to 67,788. So let's say, 2008, I don't know which the best month was, but, it may well have been sometime in 2009. So 2008, we had a huge downturn, everything got very ugly. And so you just go, I have no idea where this is going. I'm taking my money out of the market. And you do that, and then you missed the best month in there somewhere. I don't know which month it is they're referring to, but you missed the best month. You just locked in a 10% loss over what you would have achieved in that 20-year period. That's just 1 month. That's just making one move saying, okay, things are sideways and weird and I want out, and I go out and put my money on the sideline for a month, and then I put it back in. And boom, that done down my return by 10%. But let's say it was a little more serious than that. And believe me, again, I've been fielding a lot of questions on this over the last couple of years. What's going on? Is my money safe? Should I be putting it somewhere else? And it's kind of like, well, I don't think so. I think we can have faith in the market, but over the long run. But yes, things are very unpredictable right now. So let's say we missed the best, let's just say 6 months. Well, now we've dropped from a $743,000 return here when we stayed invested to $433,000. That is a pretty serious drop right there. But it's easy to get, if you get spooked, you probably stay out for quite a while. So let's say we stayed out for a year. Well, now we're really sinking. Now we're at about 42%, going from 743,000 to 310. In fact, over 20 years, our 225 hasn't grown that much, probably hasn't kept up with inflation. So that's why we stay invested. We stay invested because the market has shown resilience through centuries of return now. And we've got over 250 years of data. And we know that things, when they go down, they come back. And that over a long period of time, depending on which markets you're invested in, you can, I think, realistically expect 8.5% to 9% rate of return if you're invested in equities. Now, if you're going the balanced fund approach, because the person at the bank selling you over the counter is trying to sell you that because it keeps them safe, then you're not going to get anywhere near that rate of return. You're probably going to get around 5.5 over a long period of time, which that's okay. Go back to our original calculator. If you can reach your goal at 5.5, then that's fine. You just have to plan for 5.5. Actually, we'd be looking at our pay yourself first calculator. So if we go down to 5.5, then we're still, we're figuring out, if we want to get to that $1 million, let's see if 15% will get us there. Whoop. Nope, that gets us to 860. So, we go from 10% to, let's say, is it 18? Yeah, it's about 18%. Okay, so that's the cost of a lower rate of return. That's not factoring in inflation at all. Okay, so we're looking at why you need to stay invested. So let's just review our principles. And I'm going to put the URLs for all these tools in our chat box here. Also, they'll appear on screen. So we've got the how to become a millionaire. And then we've got the pay yourself first. And then we've got the cost of waiting. And finally, that is your pay yourself first. Whoops. We put Tara Lee's comment up there. Thank you for that, Tara Lee. And there's your cost of waiting calculator. And then finally, your stay invested. Calculator. All right, so you've got your 4 calculators there. You can go and play with those to your heart's content. See what you find out. But those are the steps. Set your goal. Pay yourself first. Don't wait. And stay invested. Now, there's some other significant questions, obviously. We've done previous shows on, for example, what kind of vehicle, I'll call it that, or bucket should I invest in? So 2 of the popular ones in Canada are Registered Retirement Savings Plan, or RRSP, or the tax-free savings account. That's a big question. If you want to know more about that question, look at our previous broadcast on that, or drop us a note and we'll be happy to answer that for you. Just ping us on Facebook, or better yet, join our group. And we'll answer those questions. Now, my advice, so of course you actually have, what have we got here? 14 days, is that right? 30, seems about right. 13 days, I guess. Nope, 11 days. Sorry, 11 days until the Rsp deadline here in Canada. And so what the Rsp deadline is is the time where you can still contribute, make an RRSP contribution to apply to your 2021 taxes, which means you would probably generate, well, you would lower your tax, the amount of tax you had to pay for 2021. Of course, you can also contribute right now for 2022 for your RRSP, and you can contribute to your tax-free savings account. Now, the tax-free savings account versus the RSP is a very big long-term tax question. Most people don't think about it that way, but you are making a very, very big tax decision and commitment when you put money in a tax-free savings account versus putting it in an RRSP. And very much depending on your individual tax circumstances, both today and long into the future, determines which is the right vehicle or combination for you. So my advice would be get advice on that. In our previous show, we did go over that. We showed you a calculator that can help you make that decision. If you have questions, feel free to drop us a note. We're happy to answer. We're certainly advocates of getting advice, professional advice from a licensed advisor. Now, if I'm not saying you can't do this stuff yourself. You absolutely can. The tools have never been better. The access has never been easier. But the high overhead is you really have to know your stuff because there's a lot of complexity and you have to make good decisions. And so you have to become a real student of these things and you have to pay a lot of attention, regular attention and ongoing attention. So if you want to do that and you're willing to invest the time to do that, I heartily believe in that. I think it's great if you manage your own finances that way. But for most of us, we don't want to take the time to do that. And so instead, we want to get some advice, right? You know, same way I could work on my own car. Well, I probably couldn't, but it's possible to work on my own car. But it just requires far too much, and I have other things I want to do with my life. So you want to get professional, high-quality professional advice for these things. So that covers what we were going to cover today. I want to, again, thank our sponsor, the Simple Plan community. Come join us there. We'll answer all those questions. You can find all these broadcasts in there, and we can really drill down into these calculators. We've got lots of other calculators we can share with you. So join us, won't you, there, facebook.com/groups/Simple Plan community. So next week, we're going to take a look at, well, what is it that goes into an actual financial plan? And we're going to do more one-off shows down the road. This is all part, we're just coming to the end of our series for the start of 2022. So we're going to be wrapping that up. Next week, we're going to talk about what is a plan and how and should I work with an advisor. And so we're going to actually show you how we build a plan, what's in a plan, and all those nuts and bolts. And that's going to be our last episode in this series. So I hope you'll join us next week. You can find us there on Facebook. And we look forward to being with you again. We hope you have a great Family Day weekend for those that are celebrating that in much of the country. And if you have questions, drop them our way. We're always happy to answer your questions. Thanks very much for being with us. And don't forget to follow us.